All right, well, welcome everybody. Great to have everyone here, and very big thank you to everyone at William Buck for hosting us in this fantastic venue. For those of you that have been to Captain's Table before, you remember where Guy very kindly offered his fantastic office overlooking the river. We were there for 2 or 3 years, and so thanks Guy, and thanks for all your ongoing support at Captain's Table. Thank you very much to our sponsors and supporters, and we've got 5 supporters, and we're going to be building up again. We've had 80 or 90 people to Captain's Table pre-COVID, and we're going to slowly build back to the levels that we used to have. And so we're really happy that all of you are able to make it and join us here. And thanks to our sponsors, William Buck, A Positive, we've got Darren here, and Digit Pro, Michael Yarrow sends his best regards. He's gone down sick really badly, unfortunately, but hopefully he's going to come out the other side well. And we've also got Ayers Group as our supporters, Digit Pro, William Buck, who did I forget? And Job Adder also. We've got anyone from Job Adder? Not today. But anyway, we've got some additional special guests. You're all special for being here, but we've got Di, who's the director at William Buck here, who's allowed us to host, and Lloyd I'll introduce you to in a second. Maya, who runs Seaforce Global, offshore recruitment, now has 65 workers out in the Philippines, which is pretty impressive. Well done, Maya. Out of Melbourne, so it's a great Melbourne success story. And also Adele, who is going to back me up on Captain's Table Melbourne and eventually take over as my successor in Captain's Table Melbourne. But Adele's also most well known for Consultants Table, where she does really high level advanced consultant skills training, and her business right now is training consultants into the industry, experienced or non-experienced recruiters that want to come in and learn recruitment and do really well in the industry, because there is such a shortage, as you all know. So I've tried to involve everybody in my welcome, and Lloyd, thank you very much for speaking with us today, and thanks for all the preparation work you've done, and thanks for having us at this great venue.
My pleasure. Thank me at the end, hopefully, rather than the start. Good morning. I have to say there's some nervous energy for yours truly. It's been a couple of years since we've done anything like this in person, so bear with me. But as Tony said, my name's Lloyd McGeary. I'm a manager here in our business advisory division. And our topic today, maximising the value of your recruitment business, amongst some other things. Just to jump into it, who is William Buck? We're the oldest mid-market accounting and advisory firm in Australia. And as you can see from the map, we've also got a couple of offices in New Zealand. Close to 1,000 professional staff nowadays, and really our clients are small and medium enterprises. We don't compete with the big 4, we're not going after big multinationals and ASX listed. We're really focusing on small to medium, from either sole traders up to nationwide brands and networks. We also do quite a lot of inbound business, so multinationals that do set up smaller Australian operations. We do quite a lot with them, because the Australian corporate environment is not an easy one to navigate, and Diana's giving me a big smile at the back, so she knows best. Because of that, we really have an emphasis on for-profit business. So we really do work closely with business owners and key staff. I guess in terms of maximising the value of the business and really looking at generating wealth for business owners as well. As a part of that, and what I really like about William Buck and mid-tier firms is that we do have a full service offering. So as I said, I'm up in the top left, business advisory. Probably think of me in its most simple terms as your BASs, your financial reports, your tax returns. That's our bread and butter. But a lot of what we do is business planning and strategic planning. And some of the things we're going to talk about today in terms of maximising the value of your business, putting in plans to really grow, that's really what our day-to-day is in business advisory. But in terms of the rest of the business as well, tax, whether it's technical transactions, the tax implications on business sales, capital events. Certainly we have the tax guys in to dot the I's and cross the T's. Audit and insurance, certainly for our bigger bigger entities that require audit, and certainly going towards business sales, whether audit is appropriate for your business, to really, again, dot I's, cross T's. Corporate advisory, I guess this is what we traditionally call M&A, mergers and acquisitions. A dedicated team that really just focuses on valuations and the business sale process. Restructuring and insolvency, hopefully you'll never have to talk to these guys in your business life, but they really do work with clients to do business turnaround and navigate choppy waters. And probably finally, wealth advisory. So this is, all well and good to talk about your business and your growth in your business, but unless you've got a plan in your personal name to really translate some of that into the pot of gold at the end of the rainbow, it's all a bit for nothing. So wealth advisory is your classic, personal advisory. Insurances, your income protections, your life, how important that is, at my age rather than retirement. So really working with people through their life cycle. And then in terms of our recruitment industry specialists, there's my mug on the right-hand side. That is pre-COVID, pre-mortgage, and pre-having a child. So I'm looking quite sprightly and young. My core expertise is really professional services, and I certainly work with Cameron Martin out in New South Wales and Angela Jeffrey as our recruitment specialists. So really, even in terms of putting these slides together, quite a lot of back and forth and discussion, and it's really nice to be able to bounce ideas off with those two. And I guess before I get into it, for me, the recruitment industry I quite like. It's a slightly extroverted industry, as we know. It's a people industry, and that suits me just fine. What I also can really respect about it, and what I don't think recruiters get enough credit for, is the real balance between commerciality and placements and relationships. That's a really hard balancing act to keep everybody happy and walk away sort of to maintain some of those relationships going forward. So it's something that I think accountants can certainly learn a lot more from. What we're going to cover today, probably three distinct areas that we wanted to cover up on today. The first being economic and industry insights. The second being the main part of the presentation, maximising the value of your business. And we're really going to look at, well, what does a valuation of a recruitment business entail? And probably the most important part, tips to improve the business value. We'll also touch on what the process of a business sale looks like, including due diligence, who a potential buyer is and how to target them, and tax structures to suit the sale of the business. I'd probably also say it'd be completely remiss of us to be in the office of accountants close to 30 June and not have a little look at end of financial year planning, and hopefully some tips to ease the coming pain. If you've got any questions throughout the presentation as well, put the hand up. Happy to try and answer those as we go. Probably the other housekeeping, there is a bathroom just there as well. I think that would be it. Let's get stuck into it. So economic update and industry insights. The first point here, COVID-19 government support, there isn't any. We're done. We know the JobKeepers end, there's JobMaker, there's the government grants, there's the lease incentives, all of those are really winding down. But from our perspective, and certainly I think we felt this in the recruitment industry, it did its job. A lot of business is really well placed coming out of the 2021 lockdowns to really tackle 2022 problems and really go for growth. On that though, now that the election is done and dusted, regardless of who won it, we all expected as tax agents that the ATO is about to go really hard. We've just spent a lot of money and we're going to want to start to recover it. So no more COVID-19 support, and if you've got outstanding bass debts, please pay them before somebody starts chasing you.
And the COVID loan program, is that finished too?
I don't know about the COVID loan program, Tony. To be honest, we've had some clients look at it, and with interest rates as low as they were anyway, it may not have really been worth it. I'm not sure, Campbell, you had any experience?
They were difficult to get.
Yeah.
They did keep pushing back the dates. I think they're pretty much done now. The banks have told us if you owe $1 to the ATO, you will not be getting any more access. So the banks will start to crack down.
In terms of the general economic activity, and I hope this is the case for everyone in the room, it's been record profits. You know, certainly April, May of 2020 we had the dip, and then it came roaring back to life. So quarter to quarter, month to month profits, they've been at record levels. And probably for the people in this room, you'll know better than I do as to why that's happening. It's because it's a candidate short market. We know that if you've got a good candidate and you've got good relationships with clients, it's more or less a guaranteed fee when you can place that role. Probably the analogy that we draw is one to a hot property market. Now, if you've got a quality property in a quality suburb and the market's growing, that agent's rubbing his hand. He's saying, I'm going to sell this within the week, and it's a guaranteed fee for him. So it's really been generated by that unemployment rate and the willingness to jump around in industry. Probably with that, and one thing that we may not have seen before in the recruitment industry is the ability to take on what you want and really shunt away what you don't. So one of my really good friends works in IT and software recruitment. He, 12 months ago, had a client come to him and said, we want to place a role, we want it to be 5 days a week in the office. I can't do it. I can't do it. It's Melbourne. It's in that particular industry, no one's ever going to sign up for that role. So it's a real luxury to really pick and choose and not bite off more than you can chew. I guess the other thing as well is that there's both strength in temp and perm. Yeah, it's been really, really strong, and even to a point in time, again, in that same software industry, you'll have candidates say, I just want to do temp work, because it's going up and up and up and up. I don't want to take a permanent placement. I'll take a 6-monther, and we'll renegotiate after that. So really, when your margins on temporary placements are over 20%, we know the market's really hot. Now, I don't want to go all doom and gloom, but inflation and world events, there's probably a few clouds on the horizon. So we know that economic activity has been really strong, but we know that inflation is creeping up. Now, whether you come from a school of thought that says that's just because of supply chain hiccups or it's more pervasive in the economy, we know that the RBA has already factored in 6 to 8 interest rate rises over the next 18 months, or at least the market's factored that in. We also know, and it's a bit of a cliche, but we've got some economic risks more broadly. Russia and the Ukraine happens and petrol goes over to a litre. The continuing America-China tensions. We know that there's some uncertainty in the global economy. So what could that mean for the recruitment industry going forward? And I'd probably take the analogy of somebody that really lives in the mortgage belt. You've got 2 kids, you might have private school fees, and suddenly the interest repayments on your mortgage are 2 or 3 times what they are now. Now, are they going to jump to a new job for 10% more, or are they going to go, oh, I really need my guaranteed annuity, aka my paycheck? So, yeah, maybe there's some opportunities, but I really need to put the family first, I need to put my cash flow first, so I might just stay put. Conversely, if somebody's coming back into the workforce from 3 days a week because they've been on childcare duties, are we going to go for a new job that pays more, or are we just going to request to the employer, hey, this is a really stable job, can I request 4 days a week? So economic activity can still remain really strong, but there might not necessarily be the movement in the industry that there has been. What we'd probably say on that is you've got to capitalise on the opportunities now. Where we've had strong cash flows, investing in your people, investing in the business, investing in a strategy to keep growing the business is really important. I think when April and May of 2020 happened and the world was falling to pieces, in particular pre-COVID, we often talked about 90 days operating expenses for cash. We want to have enough cash in the bank to cover 90 days of our business without a cent of revenue coming in. But if we jump forward to May 2022, boy, not a lot of our clients have actually done that. So there's still some pretty weak looking balance sheets out there. So really, if you can, focus on your cash reserves and focus on putting the business in a place that can really, keep it healthy going into the future if we do have a softening of demand. Anything to add from your perspective, Tony?
All good, Lee. Very
All good?
Okay. Sorry, just a quick question.
Yeah.
You mentioned about sort of investing in the business and growing the business, but be mindful about having, enough cash reserve.
Yeah. Yeah,
how they go together.
Yeah, they're certainly competing interests in that, and at the end of the day, it comes down to cash flow and your bottom line. We certainly, we still see businesses that might only have 15 days operating expenses on hand. They really struggle. If the debtors aren't coming in, they're going to really struggle to pay bills. So, probably from my perspective, first and foremostly, you need liquidity in the business. Cash is king, and that comes first. But if you can spare excess cash, if you do think that there's a relevant asset or a training item that will actually result in a growth of revenue and a growth of profit, listen 1 to 10, what's our top priority? And we can start ticking off the list when we've actually got the cash to do it. But I'd certainly acknowledge that they are competing interests, so easy for me to say, hard to do in practice. So probably to turn 180 now, how is a business valued? And up front, I think the next slide is tips to improve the business valuation. So that's probably the one that we really want to focus on today. But how is a business actually valued? Now up there I've got 3 valuation methods: discounted cash flow, asset-based valuation, and market-based valuations, or earnings multipliers. I think we will send the slides out after as well, yeah, thank you. Now, the first 2 are really industry specific. You're either talking mining or IT, asset-based valuation is property. So really, I'm not going to talk about the first 2, and we're going to go straight to the market-based valuation, the earnings multiplier. And for that, I do have an example of what I'm actually talking about, so to try and give you something tangible to actually look at. Now, hopefully, I do with that. The IT system worked. So, really broadly, the earnings multiplier is where we look at an adjusted net profit. So this is a standard profit and loss that we've pulled out. And hopefully you've seen this before. You've got professional fees, salary and commission, you've got other income, including JobKeeper, and general expenses. That then gives us a net profit. When we talk about adjusted profit, we're really talking about EBITDA. I'll try not to get too technical because I very much like the numbers, but I can understand some people in the room may not like them as much as I. But EBITDA is earnings before interest, taxation, depreciation and amortisation. When we do adjustments to our net profit, there's also some really other common ones that we do to normalise your actual profit. So that might be less personal expenses, because God forbid if we're running a small business, we sneak some personal expenses through there and tax deduct them from time to time. Might be less government stimulus as well, because JobKeeper was an artificial stimulus item. It's not a real indication of your bottom line. And we might make adjustments to your salary. If you're only paying yourself $50,000 through the business, but really your work is worth $150,000, we'll need to make those adjustments as well. Again, I don't want to get too bogged down in this process. It's quite a standard thing that we look at when we do business valuations. But that takes our net profit from that 716 odd to 582. When we talk about an earnings multiplier, we then simply apply a number. And that's it down here. So this business, we're valuing between a multiplier of 3 and 4. So we're saying the business is valued somewhere roughly between 1.7 and 2.3 million. Have we somewhat understand the mathematics from now? That's the heavy lifting math part of the presentation. Probably the next question you have is quite naturally, well, what's a multiplier? If I go back to the slides here, oh, that's the wrong one. What is the actual multiplier? Now, thankfully, recruitment is very similar to other professional services industries in that multiplier is generally somewhere between 2 to 5. And that's in a lot of transactions and experience in business sales. That's what businesses are valued at worth. And in one sense, it's very much willing buyer, willing seller. So you can sit down, you can do the maths, you can find a multiple and say, well, that's exactly what my business is worth. but it's really only the starting point of the discussion. Really, for back of the envelope valuations, we'll use a multiplier of 3 because on any given, reasonably average, well-maintained business, 3 is generally a pretty good indication of what that business may be worth. But it really depends on quite a few factors, and again, we'll touch base on those in the next slide. If you're a really small firm, if you're really a one-man band, if the key business owner is doing 50% of the revenue, and you want to walk away from that business and sell it for a top dollar, your multiple might only be at 2. Or even then, you might struggle to sell the business because you are the IP of the business. If though you're really well run, you've got a larger team, you've got management that's really staying put in the business and it can more or less run itself, you're going to go for a multiple of 4. You're going to push it up to 5. Again, the multiple is only really the starting point of the discussion. It is mathematical and there's a whole other host of items that go into really pushing that number up. I think out of any slide, hopefully you get something out of this today. And they're little tips, but the first thing I'd want to start with is, this all comes back to planning. You really need to think about some of these things over a 3 to 5 year time horizon. Because if somebody came to you tomorrow and unexpectedly said, hey, we might be interested in acquiring your business, you can't change these items overnight. They take a really, really long time. So, first and foremostly, plan ahead. First on the indented list there is specialisation and strength of the brand. So we know that brand strength is really important where you've got a known and positive reputation in a particular industry. We know that half the battle with recruitment is getting your name out there, is actually being considered. And certainly mathematically that's going to kick your multiplier. It's going to move it from a 3 to a 3.5 overnight if you've got great brand strength. Probably a good example that I have is, me personally. I finished CA at my old firm and I didn't love it, and I was out the door pretty quickly. And I've been a happy little camper at William Buck ever since. But you jump online and there's going to be a Hayes Recruitment that are absolute generalists and they're advertising for everything. But my wife used Dine & More. So through her, she had a positive experience. I went straight to a specialist in the accounting industry, Dine & More. They're not a client, I'm not plugging them for plugging them's sake. But certainly, that's what I value. And when you're talking about business sales, that's really the example of, we've got a known base, we've got good referrals, and we've got a good network in the industry. You can more or less guarantee yourself a higher multiple, or at least negotiate over it. I think as well, as we touched on before, the management team. It's a really simple fact that owner-manager businesses are valued less. And it really comes down to your key man risk. If a potential buyer knows that you are the show, and if you're gone, those clients are a really high risk of walking away, you really can't expect a really high business valuation. Because no one in their right mind will go, oh yeah, absolutely, your rev is this, we can continue that, not a problem. We know there's going to be a drop-off. So really that's going to lower your multiple. What does that mean? What can you do now with your up-and-comers? What can you do with your management team? Or some of your more hungry guys to keep them interested? And there's heaps of different ways you can do this, whether it's employee share schemes or profit share arrangements, trying to get them thinking about the long-term health of the business. Not just, this is great, 50% commission, I'm going to do some deals, my quarter's going to be huge, but trying to get them thinking about, actually, if we do some things in the business now, this is going to help us in 12 months, 24 months. This is going to help us holistically. Again, easy for me to say, probably the hardest thing to do in practice in any business. And this is really where the 3 to 5 year plans come into place. I think as well, we know that people leave. So when you're looking at business vals and you're thinking about selling a business, you're going to have false starts with staff. And I'm talking to a room full of recruitment business owners, you know that better than I do. Customer mix. We really want a diverse customer mix in the ranks. There's probably an old adage in business valuations that if you've got a customer that's over 20% of your books, we're instantly going to value that back down to 20%. It's all well and good to have a golden goose on any given year. We know that that's great for the bottom line. But again, that client really reflects a flight risk for the business valuation. So if I went over to one of our M&A partners and said, I've got a business, $1 million of revenue, now one client is worth 600,000 of that. Unless you've got exclusive contracts in place, unless you've got agreements in place that really lock that in, he's instantly going to go, no, it's not worth 600 on the revenue, that's only 200. We're going to halve the business value straight away because there's so much risk tied up in your customer base. So thinking about a diverse range of clients and really planning to try and ease out of one big client if you can will really help with your negotiations come crunch time as to, yes, this business is worth more because we've diversified our risk, much like with an investment portfolio. I think on the same basis, your temp v perm split is also pretty important. Now, if you only did temporary placements to the hospitality industry in April of 2020, your business ain't going to be valued all that highly. If you only do permanent placements in the IT industry in September of 2020, rivers of gold. Things change. Things change all the time. So having a diversified split between those two can really help, again, diversify your risk and improve that negotiation position come crunch time. We'd probably say in terms of an annuity type thing, temporary can be really good come a business sale time. You might not quite get the margin as you would as a permanent role on any given placement, but temporary represents a really good annuity. Now, if you can lock something in for 6 months, 12 months, or they keep rolling, that's a really good way to actually tell a potential buyer, hey, this isn't just the value of the business, these are the guaranteed roll-throughs that we're going to have. This is sort of a trail book, if you will, of revenue that's going to be coming into the business and is more or less guaranteed.
Quick question.
Yes.
Regarding temp versus perm.
Yep.
What are people looking for in terms of a split? Is there a preference to have more temp or 50-50?
It really depends on the industry and how quick the market is. I think when things are a bit slower, permanent placements are really good because if you can place them quickly and you've got a good 20% margin on that, you know, if you can place that within the week, that's a great payday. Temporary, I think probably a big problem with temporary is getting the margins right. So we think that we're making a lot of income with temporary, but unless we've really thought through what the on-costs are, if you're doing pure labour hire and it's only a 12% margin, well, once you've assigned all the overheads and time for collecting and whatnot, maybe you're going backwards. There's no fixed product. It will really depend on your industry. So you know, maybe if you're in the arts industry, it is a bit harder to get permanent placements on any given, you know, is that your experience? I'm not quite sure in terms of particular industries.
That's right. You're correct.
Yeah.
Yeah. It depends is the answer.
How long's a piece of string, I guess? You know, for say the accounting and finance industry, we're so hungry for staff. You know, it's been real growth time. So you want perm because you'll be able to get them out within the week. If you're in software consulting, they know that they don't need perm because there's so much demand. They'll want temp. So you'll also want to go temp to manage the books from there. A healthy mix, but what that is really industry dependent. Good question.
I think having, I do safety roles, and having a good base of temporary really sets up your return to become the cream.
Yeah. So cover your expenses with your temp and then your creams.
So we'll push a lot more temps out there as many as we can all across Australia, and then the firms are just that extra.
Not to go into the technical accounting of it, but if your temporaries are covering all your fixed costs, if your temporaries are sort of paying for everything and your permanent is on top, that is a great model. You just, again, have to be aware of market movements, things changing, exposures, but they're general business risks that are really hard to mitigate from time to time. The bigger the business, the size of the business. This will matter in terms of probably a lot of the points we discussed above, but take your management team. If you've got a bigger business that has a well-run management team, you've eliminated your key risk. We also know that bigger businesses are just valued with a higher multiple. So your really big accounting and law firms around town, they're going to be arguing for a 6 or a 7. Smaller businesses, they'll struggle with those numbers. It might only be a 2.5, a 3. It sort of explains why larger businesses often like acquiring smaller ones, because they might acquire a business with a 3, but overnight they're going to say, well, it's actually worth a 6. So it might be worth $1 million to you, but as a part of our brand, suddenly it's worth $2 million. We've added it to the bottom line of our business. Beware with size though. Sometimes we go for growth and we go for size, but we kill our margins in the meantime. So it's all well and good to put people on, but unless you're actually showing profit from that growth, it really doesn't mean much at all. Profit trend. This is the easiest thing that a potential buyer can look at. See if it's going down, we're not looking any further. We're absolutely not looking any further, because why would I want to buy a declining business? Unless you've got a great reason as to why there's something in there that's worth something that's not actually shown, it's really easy to just say, no, I'm not going to look any further. Profit trend is made up of both your revenue, and sometimes increasing revenue is pretty hard, but also your expenses. And really reviewing the expenses is important for your bottom line. So again, God forbid, we sometimes push some personal things through our books and tax deduct them, and it's a bit of a naughty, but we know it happens. So do we have private cars in there? Do we have some travel that, I don't think there was a conference in Port Douglas at that particular point in time. What can we actually take out of our numbers to improve that bottom line and more accurately show the health of the business? What do all of these things do? Well, mathematically they help that EBITDA number. They increase your net profit and they put you in a stronger position to say, no, my multiple's not a 3, it's clearly a 4. That's where we're going to start negotiating from. So again, this isn't an exact science. It's not something that the accountant can sit down and bash out and say, your business is worth 1.725. It starts the negotiation procedures, but puts you in a much stronger position to do so. Probably this slide I really like. It talks about, if we've just talked about what are some of the things that you can do to improve the value of your business, this talks about factors that can erode the value of your business. So right over here, this might be your expectation of what your business is worth. We think it's right up here, it's sky high. These two in particular, poor preparation and poor quality of information, if you're not in the right structure, God forbid for recruiters, if we don't have the correct contracts in with our key staff, if we're late on our lodgements, if our financial information is poor, right there, that's going to start to decrease the value of the business and you won't be able to recognise nearly as much. Loss of focus by your management team. Now, we certainly see that as you get closer to retirement, you sort of start thinking about the golf course, you might not want to be as involved as much as the business. What strategic plan can you put in place? How can you work with your wealth advisor as well to say, if you keep up the intensity, this is going to be the end result. We want to grow that pot at the end of the rainbow, so how can we keep ourselves focused on it? Probably the middle one here, competitive responses by suppliers and customers. Things happen. If you're doing placements to a government agency and they just decide to review their policies and change suppliers, there's not much you can do about that. But it does decrease the value of the business. On the flip side, if you can gain some things through the negotiating process, if you think that the profit's going to start to go up because you've done some really good business development work, that'll be the opposite. And probably the last two here are price adjustments from due diligence and the completion accounts. Now that's the really pointy end. That's when you've already sort of been dancing with a potential buyer, and they're the sort of things right at the end that the accountants and the lawyers will hash out, but sometimes some of those transactions will go against you. If in actual fact we weren't accounting for something correctly and maybe there was an unexpected tax bill, expect that business valuation to go down. The business sale process. Probably some of it goes to what I was just talking about. Really the first two there being clean up the accounts and put some systems and processes in place to actually produce a nice quarterly report or to produce something clean. So if you do get a tap on the shoulder, you're ready to say, yep, this is what we are, this is the business and this is our well-run business. On that as well, putting in place your systems and processes will certainly enable you to do some better benchmarking on your margins and put together your financial reporting pack. Because no potential buyer is really going to take too much of an interest in you if it takes you 8 weeks to put together your documentation. Inherently, you're a bit unorganised, so I'm probably going to be less inclined to go forward with you. Probably the second last one there, the information memorandum and presenting the business. Really, the IM is the opportunity that you have to really sell the business. By this point in time, you generally have signed a non-disclosure agreement with the potential buyer, so we've got some safety and confidentiality. Often a one-page teaser as to, yep, this can be the business, and if we're going forward, certainly our corporate advisory team they'll put together packs of between 30 to 50 PowerPoint slides to really sell the business. And it's not just the numbers, it's all the intangibles we talked about. Yes, we have our key contracts in place with our clients. We have a profit share team with our management, and this is what we're doing, with them in the future. These are our strategies to really maintain profitability of the business. It's the sales pitch.
So you're trying to build up the all the arguments for higher multiples in that process.
Yeah, exactly. The net profit's the net profit. The numbers are the numbers. But the IM, as you said, it's all the intangibles. It's saying, no, my multiples are 5, and I'm digging my heels in.
A quick question, in terms of having key employees as shareholders in the business,
yep,
to obviously keep them in the business and engaged, as a prospective buyer, what do you look for in terms of, because obviously if you've got key employees that represent 80%,
yep,
they have ultimately a voting decision as to whether they proceed or not. So what would be the fair breakup of how much actually do you want to give your employees, but still, obviously to make it appealing for external businesses? I presume obviously you want to have control and interest at 51%.
Certainly.
But do you sort of give up 20, 25%, or does that depend on the size of the business?
Depends on the size, depends on that management personnel as well. Generally, if you're talking ownership, if you're talking like an employee share scheme or actually transferring an ownership of the business, you're probably going to want some confidence that this is a person you can actually sell out to in the long run. Now, in terms of a business sale, that still shouldn't make a difference to the valuation. The business is the business. If the new owners can negotiate in a way that says, yes, the staff member has 10%, they'll continue to hold 10%, or it's renegotiated. There's a million ways to structure a deal, and hopefully that wouldn't impede it. But if you've got an intention of selling 100% to a third party, and you actually don't really have any intention of selling to your managers because you don't see it as a foreseeable and viable sale, maybe you're not going to be selling them equity. Maybe you'll put in place a phantom plan. So something along the lines of, if we make X profit, your share is 20%. And still incentivise them, still say you will get a profit share of the business. You will effectively have phantom equity in the business and an entitlement to a dividend, but you actually don't own the underlying assets. It really comes back to your exit strategy and where you think you can maximise the value in your exit strategy. It can also come down to not just the harsh numbers. If that manager's been with you come hell through high water, then maybe they do take on 20% of the equity, and you work with them in the business sale to say, this is going to happen. If you want to buy it, great. If not, we'll keep you. We'll take you through the process so you can also realise equity when we go to sell this business. But it's so individualistic in terms of who, why, when, how. There's really no one size fit all on that one. Again, good question. The actual due diligence process, I would best describe this as an absolute tsunami of paperwork. This is where the accountants and the lawyers will want to absolutely tear apart everything. And I've got a simple due diligence list that we were sent a couple of months ago, all 52 items of it, starting with monthly trial balances for income statements and balance sheets and general ledger accounts by function cost centres. I barely know what that means. Okay? We're going to talk 2 or 3 years basis. We're going to talk every single payroll tax return you've lodged. We're going to talk work cover. We're going to talk income tax returns. They're going to tear everything absolutely apart. So not only do you need that 3 or 5 years to actually clean some things up, because there's some sort of skeletons in the closet, we recognise that. But if you can't answer this list in a week or two, well, you're pretty disorganised. You know, if you can't quickly provide this information and somebody can say, oh yeah, they pay their BAS on time, that's really going to get them asking questions. And part of the due diligence process is them not asking questions. You really want to, yes, here it is, it's squeaky clean, move on. Because really the due diligence process only decreases the value of your business the more questions that they ask. So being well prepared is absolutely key on that.
How far back will they look, Lloyd?
I think if you're talking startups and you know that industry, you're going to be looking at 2 years, 3 years max. A lot of it will be based on projections, and a lot of this DD can be based on not just your actuals but projected numbers as well. So it does get hard. If you're a big, stable business, you know, expect 4 years. So that's a lot of information and a lot of dotting of I's and crossing of T's. Particularly something like a William Buck, you know, we've got 170 staff in Melbourne. If somebody was to acquire us, yeah, they'll be asking for 4 years and they'll be absolutely going through every single thing we've ever lodged. COVID's a bit tricky with it. I know Campbell and I have done a few with COVID where, you know, if lockdowns affected you, but then you've come out of it, but things have been boom time and they're not quite, you know, they may be asking for less information, or they'll be putting less emphasis or weighting on some of the older information, in particular the financials. That EBITDA number, they really might be only looking at 2021, 2022, they might discount 2020. It's all part of the negotiation though. But at the end of the day, if they ask for something and you don't provide it, no, that's going to be a bit of a cross in your side of the ledger. So who is a potential buyer and how do we target them? There's various sale options. What I'd say is that we always need to keep an open mind because we never quite know where the next opportunity is going to come from. Certainly as I talk about, you know, management buyout is a really viable option. If you've got strong management, if they're keen, if you can really incentivise them and have a really clean handover, it's not like you're saying to, oh hey clients, we've sold out to XYZ, so they'll be the new relationship manager. It's a really slow and gradual process. And it's probably something that, you know, your bigger accounting and law firms, if you take partnerships here, you have retiring partners, most of the new partners are organic. They're coming from inside the organisation, and it's quite you know, as seamless as it can be. It's a pretty seamless process. Industry specialisations as well. They're really important to attracting competitors in the market. You know, as I mentioned Dine and More before. Well, if you've got another actor in that market, that's going to be really attractive. People know one another. You know, there's already a brand. There's a specialisation. It's easy to transfer the IP. That's a really good potential buyer for you. And it really comes down to that bottom line, the importance of networking. Never not have a coffee or a beer with your competitor. You never quite know where the offer's going to come from. We always want to stay civil at all time. Certainly never burn any bridges. I guess as well, your large local or international acquisitions. Cameron and I had a really good chat about this the other day. We really don't see, compared to other industries, international acquisitions in the recruitment industry, particularly in Melbourne. It's quite slow for that. And then even compared to some industries, the local acquisitions as well haven't been, I guess, as hot as some other industries. But I guess going forward, we would expect continued action, continued business sales within the industry, because that's generally how it happens. Somebody in Melbourne will buy at someone in Melbourne. Somebody in Sydney will buy at somebody in Sydney. That's just generally what we see most commonly. Probably the other thing actually is visit some other businesses, go to some conferences. Certainly we have connections and conferences in the US, and a lot of our inbound clients come from some of those contacts. So you never quite know when somebody says, oh hey, we met at this conference, I'm thinking of coming over to Melbourne, maybe we should have a chat about that. And beauty, now I've got somebody that's really looking to set up, whether you can sell or partner with them, really going to increase either your sale or the business going forward.
Do you have any, do you work with people who might go and advocate on behalf of a seller to say, here's somebody who's a client of ours trying to sell, and
Yep.
are you interested in, what does that look like, please?
Absolutely. Our corporate advisory team do that day in, day out.
Yeah.
So it's really not only their personal networks, and this is all that these guys do, so those networks are large, but the way that you can structure your IM for your business sale process and your teaser and placing them in the appropriate markets, advertising it. I don't know too much about the dark and confusing world of M&A, but it's more or less getting about town and using those connections and leverages and leveraging the relationships.
Talk to a lot of people.
Yeah, in addition, there's plenty of money going around in private equity at the moment, and
Yes.
a lot of M&A activity. So if your business stacks up and you've got good ratios in place, there's plenty of people looking to invest at it. 3 or 4 times is pretty cheap relative to the share market trading at 18 times. So
Yeah, that's a good point. And Lloyd, you mentioned other industries or other professions, if you like. Is there anything that, because you deal with, say, law firms and accounting firms, is there anything that you've noticed that they do better than the recruitment industry that could be a good idea for recruitment companies to do better compared to counterparts?
Probably some of it for me will be your training of juniors. I think accounting and law firms spend an awful lot of time going through and really slowly training them. I think sometimes with recruiting firms it's, there's the phone, go for it. Slowing down and actually really explaining what are we doing, how can we actually service our 2 clients, the companies that we're placing for and our candidates. Because I think we were talking before, on LinkedIn, I get 3 requests a week from recruiters. One of them will actually say, hi Lloyd, I see you're a manager at William Buck, can we have a chat? 2 of them will say, copy and paste, hey, here's a role, it's out in Pakenham and it's for a senior accountant. Well, I'm a manager and I live in Ascot Vale, so that's probably not going to work. So actually sitting down with your junior staff and saying, how can we better target our candidates? How can we use the tools at our disposals? But also, how can we try and build those relationships? How can you have somebody walking away from the recruiter saying, that was a really good experience, I'm going to refer them to a friend. And then, as a candidate, I had a good experience. So then maybe later on down the track, when I'm in a position to also action on the recruiting side, how does that experience translate into me then using those services? So I think it's really junior training for me is probably the lowest hanging fruit on that side of things. Would anybody else have any input on that?
I think the large accounting firms really well about brand recognition, knowing that you can work at a William Buck or a Deloitte, you can do your 3 or 4 years, do your CA, and then you're going to get a massive pay rise elsewhere internally. And I think that probably attracts people to those businesses. So I think and maybe it's the same as in recruitment, ideally you don't want someone going internally at a Aussie Super or a William Buck, etc. I think they do create almost like this brand that they've got globally that people want to work for them, and maybe can you lock people in with a training development plan for 3 years at a cost, and if someone leaves William Buck, I don't know, as an example, or Deloitte, within 3 years they probably have to pay their CA fees back. So potentially something like that to lock people in.
Yeah, good idea.
The old clawback.
Yep. Lloyd, how many transactions would William Buck do with recruitment firms in Australia in a year or over 5 years? Is it 1 or 2 a year or?
Between Cameron, Angela and myself, there's been 3 this year.
Okay.
I've been involved with one with Cameron that I've been assisting with. I think he's done another one, Angela's done one as well.
Okay.
So they're not, we're not sitting here doing only business transactions. They come up when they come up. But for me, it's the preparation that's the important part. Your actual sale can be really quick. The work and what we do with clients is in the 3 to 5 years beforehand. On this one, how I'd invest in my value business, again, much like the slide before, this is from the buyer's perspective. So if they think this is worth, the existing business here, that's what you're worth, this is how they're looking to add value and really take the business forward. Now, I hate the word synergistic gains. That's very gobbledygook to me. All it is sitting down and saying, right, how can we actually leverage the existing business and really grow it? So cross-selling. Now, the example would be William Buck has accountants and advisors. We also have payroll staff. We have HR. We have IT. We have accounts receivable. There's a lot more going on in a business than just placing the accounting candidate. So I certainly see some really good similarities between accounting industry and IT industry in terms of how you can cross-sell going forward. Your blue chip customers, they're always just nice to have on the books, and people will pay a premium for that. Elimination of competitor. We know that if you're a specialist health care recruiter, and there's only 3 in Melbourne, and you can buy one, and then there's only 2. Well, from microeconomics 101 back in the day, we know that less competition generally leads to higher prices, so you can be a bit more bullish in the market. And probably the potential to eliminate duplicated costs is also right up there. Be it rent, you're saving on 2 premises, be it advertising, and God forbid even be it accounting fees. The one here though, the integration costs and perceived risks. We've had deals where it goes through due diligence and there's an issue with some of the tax treatments and some of the problems, and there's some skeletons in the closet. And right there gets people really worried. And certainly, from our perspective acting for the buyers, there was enough risk where we went, we think you've got a good business, but we can't do this. We're not going to take that on. You can put as many warranties into contracts as you like, but unless somebody has the cash to pay you out, if something goes south, it really doesn't mean anything. So you always got to, weigh that up with your perceived risk of the transaction. Quickly as well, I'll touch on business structuring. This is a topic unto itself, so I won't spend a lot of time on it. I know we're getting close to 10 o'clock. Is your structure right for you? If you're going to do a management buyout, but you're operating a discretionary trust, you can't sell units or shares in a discretionary trust. So do you need to roll that into a company so you can actually put in place an employee share scheme or sell it progressively? Are you guaranteed that you can sell out of a partnership? What are the tax consequences on that? All things that you should be thinking of now, because structuring takes a long time, and a lot of the tax concessions really rely on those structures being around for quite a long time. You can't just change the structure right before a deal without expecting a hefty tax bill, or at least some really fancy footwork to negotiate it. I think as well, the actual structure of a deal, most deals in the recruitment industry, you'll see an earn-out arrangement. So it might be 50% up front, then it might be 50% over the next 2 or 3 years. If the numbers go north, it might increase this buyout. If they go south, it might decrease it as well. Certainly on that point, if you expect a business sale, no earn-out, and an absolute walk-away clause where you say, I'm not going to be involved in the business, whether it be 6 or 12 months, that multiple is going to go down. It's always a bit suspicious if the business owner says, your problem, and has no intention of wanting to be involved any further. So when if you're considering the business sale and you're thinking, boy, I'm ready for retirement, you need to factor that into your decision making. That was it on the business valuation side of the presentation. As I said at the start, it would be absolutely remiss of me as an accountant to not talk about some year-end tax planning with 30 June just on the horizon. And again, I'll probably quickly run through these, but the first and foremostly, have your accounts up to date, have your interim accounts up to date. There's somebody that can take a call on June the 27th saying, should I go buy this car today? I should go buy this car, shouldn't I? You go, right, are you actually going to pay tax this year? Have you made a taxable profit? Oh, I've got no idea. Well, there's no point spending money on a car to get a tax deduction if you can't actually use it this year. So having your up-to-date information, pretty crucial on this one. Immediate write-off for assets. In previous years, we've talked about various rates and 10, 20,000. Really, for people in this room at the moment, sky's the limits on writing off assets. The big warning on that is they need to be useful for the business. Buying an asset to get a tax deduction, you're spending $1 to save 25 cents. So making sure that they are actually going to be used in the business is pretty crucial.
Examples of them really quickly, Lloyd?
Whoa, look at this TV here. How nice is this one, eh?
Yeah.
Vehicles is what we always get a question of, because Australians are obsessed with cars. We love new vehicles, but whether it be IT, certainly computers, upgrading equipment, the amount of issues that a lot of businesses, us included, still have with Skypes and Zooms because we're still operating on 2019 equipment. Now, caveat on that is if you want the tax deduction, it's meant to be installed and ready for use by 30 June. So be wary of that. If you ordered something that doesn't actually hit the business premises till August, there'll be a tax deduction for next year. Employee commissions and bonuses. If you accrue for those and promptly pay them after 30 June, you can tax deduct them in this current year. You don't actually need to wait until you pay them to deduct them. So that's a good one, that if you know you're going to pay a commission anyway, you might as well calculate it and put it in the accounts now. Payment of superannuation. When it gets to 30 June, you're going to pay super in 3 weeks anyway, but you're not going to get the tax deduction for it till the next year. So more commonly, we're seeing a lot of businesses paying and deducting super, whether it be employee super or their own salary sacrifice super, before 30 June to move forward the tax deduction. Deferring dividends and Div 7A loans, those that are operating out of companies, this is really for you. What's your tax planning? How are you going to smooth some of the lumps and bumps of your profit? How you're managing your personal loans? Deferring things to the next year, really good for an upfront sugar hit, but beware, what does that mean for your future implications? And family trusts. This is a complex one. The ATO has completely changed its interpretation of how family trusts operate. So previously, if you were distributing to your adult kids and you were giving them a trust distribution of $100,000 odd, the ATO has come along and said, absolutely no way, that needs to be tied to actual maintenance. So maybe it's only 20 or 30K. These rules are really technical. They're only in guidance form at the moment, but we do expect the ATO to absolutely roll them through to this is how we're going to assess things. But coming up to 30 June, if you're not having these discussions and you do have a family trust in place, and it's not just distributions to yourself or your partner, you really need to be talking about Section 100A changes.
Sorry, Lloyd, I've got to go, but enjoyed the session.
No, thank you. We're done. So that's good timing anyway.
I killed the party. So
that'll be it for me. Thanks for coming along. As Tony said, it's great to be back in person, and we'll be at the William Black offices from here, so hopefully we can grow that.